In this video, I'm going to discuss capital flow and sentiment analysis. This is going to be the part 2 of the previous video where I discussed capital flow and fundamental analysis. Capital flow and sentiment analysis. As a forex trader or forex investor, there is need for you to understand the concept of capital flow and how sentiment in the market influences the flow of capital from one currency to the other. In this discussion, the first thing you need to identify is to, among the 8 currencies, the major currencies, you need to identify the ones that are high yield currencies. What do I mean by that? These are currencies with relatively high interest rate. For instance, you have the Australian dollar and you have the New Zealand dollar, you have the Canadian dollar. To a large extent, these are high yield currencies, and of course, majority of them, they are commodity currencies, and these are currencies that you will expect capital to flow out of anytime there is risk off. Now, before we get into what risk off means and how to really identify the position of risk in the market, we still need to identify currencies that are safe haven. Safe haven in the sense that if there is a disruption in the market in terms of risk aversion, then where will capital flow into? This could include, we have the Japanese yen, we have the Swiss franc, we have the US dollars in some cases, we have gold, and in some cases, currencies like GBP and euro, they can be neutral. Sometimes when there is risk off, you notice that as much as capital flows away from the high risk currencies into the safe haven, there is still likelihood for euro to behave as if it's safe haven, especially when the interest rate at that time is relatively lower than that of the commodity or high risk currency. So quickly, let me show you how to understand sentiment. Gauge, how do you gauge the level of sentiment in the market? Now, when you overview fundamental indicator or fundamental stance globally, regionally, and even nationally, there is likelihood that the presence of a particular geopolitical stance can trigger panic in the global market. For instance, like we have in the case of COVID-19, like we have in the case of this current tariff war between USA and China. These are events that are unexpected. It can even be natural disaster. It can be conflict. It can be as simple as election in maybe in a major country. Now, these are events that has the tendency or likelihood to lead to an unexpected, or what we call unplanned disruption in the policies. Now, any event that happen, whether at national level, whether at regional level, or at global level, that has the tendency to disrupt policies unexpectedly, those events, they can trigger or shift the sentiment of the market. Now, in the case of the tariff war, just because Donald Trump announced that there's going to be changes in the tariff between the trading partners, investors, the market reacted to it, and it shifted the sentiment of the market. Now, when the sentiment of the market shifts like that, it's going to move from risk on to risk off. Now, risk on is when there is a level of stability in the market in terms of policy or event, or pandemic, no disaster, no conflict of any sort that can lead to unexpected shift in policy. So investors, they tend to engage in carry trade, and they move their capital from low yield currencies most of the time, which are safe haven, into high yield currencies. Of course, these are the commodity currencies. But when there is an announcement, or there is a war, or there is a conflict, or there is an expectation of a disruption in the policy regionally or globally, investors tends to panic. That panic is going to lead to most of the investors pulling their investment out of the high yield currencies and looking for a place or an asset where they can save their their capital. Now it could be that they will be putting it in gold. They can decide to put it in Japanese yen, because these are safe haven assets or currency. Now, when you are to analyze capital flow as a forex trader, the most important thing you need to track is, when do I know, or how do I know, or how do I gauge that there is a risk off in the market? This is a very important question that, if you cannot answer this, this concept will just remain a theoretical concept. You will not be able to apply it. So what you look out for to be able to get the stance of risk sentiment at any point in time, you want to look at index of the stock market. Because when there is a risk on, you will notice that most of the stock index will be moving, will be trending up. For instance, the S&P 500 index, you will notice that it's going to be trending up. You can, if you check the Nasdaq Composite Index too, it's going to be trending up. Now, this index, this stock index, they are what will give you overview of what is going on in the global stock market. Now, when the stock market is on a bull run, it's obvious that there is a risk on. Now, anytime you see a sharp decline in the index of any of the stock market, be it Nasdaq, be it Dow Jones, be it S&P 500 index, anytime you see a sharp decline, it reflects that there is panic. It reflects that the investors, they are pulling out their investments from the stock market. And this is how you gauge the arrival of risk off. Immediately you notice that, and you are able to gauge it very clearly using those index, you will now ask yourself, now if investors are pulling out this fund, which means capital is flowing out of the stock market, is flowing out the same way the capital is flowing out of the stock market, is going to flow out of the high yield currencies like the Australian dollar, the New Zealand dollar, and the Canadian dollar. Now, if capital is flowing out of this asset now, where will the capital flow into? There is need for you to ascertain that also, because you cannot just assume that because gold is a safe haven, the capital that is flowing out of this place is going to go directly to gold. Or you say because Japanese yen is a safe haven, the capital that flows, everything is going to go directly into Japanese yen. There is an index, there are index you can use to gauge at what point is the capital that is flowing from this high yield currency. At what point? In fact, the index will show you the exact date that the capital that flows away from this high yield currency, flows into either Japanese yen, Swiss franc, US dollar, or gold. To track to the degree to which capital flows away from high risk currency during risk off, you need to gauge with an index. All these as index. You have Japanese yen currency index. You have Swiss franc currency index. You have dollar index. We have dollar index. That's what is popularly known as DXY. And of course, gold. You need to gauge by the index at what point is the capital that is flowing away from the high risk currencies, at what point is this capital entering the safe haven? This is how to track and to measure capital flow through the understanding of sentiment. You don't just approach the market to say that when there is risk of capital will flow away from all this high risk, definitely let me start to buy US dollar. Let me start to buy gold. There is need for you to wait and ascertain through the index of each of these currencies to know at a certain point that the capital is flowing into the safe haven currency. And this analysis is going to help you, in addition to the fundamental analysis that you must have done before now. It will help you to position yourself as a professional forex trader and take position that can yield profit, especially on the intermediate and the long run for you as a forex trader. These are the likely analysis that we do at Potential Miners, and this is based on the system that we launched on the 2nd of May 2025 that we call the PMI Global Macro Trading System. I will leave in the description below this video the link to the summary draft of this system. So in summary, capital flow and sentiment analysis will help you to really optimize your choice of currency pair or asset to trade by showing you how capital flow from high yield currencies into the low yield, or what we call safe haven asset, as at the time that we have risk of sentiment in the market. And of course, you will be able to pinpoint at exactly the point or the date that the currency flowing away from the high yield currency is now entering each of the safe haven assets. With this analysis, it will help you to guide against unnecessary losses in the forex market, and of course that will increase your chances of profitability in the market.